Hello everyone, welcome to today's webinar, The Rebounding Healthcare IT Services Market Offers Growth Prospects for Struggling IT Vendors, with TBR Senior Analyst John Caucis. I'm Justin Sargent and I'll be hosting today's session. Insights from today's presentation are shared from TBR's Healthcare IT Services Benchmark. If you'd like to learn more about this report, please reach out to myself or John after the webinar. Before we begin, there are a few housekeeping items I'd like to cover. First, I'll be recording today's session and posting it on our YouTube site, TBRI channel. We encourage you to visit this channel to watch this presentation or any of the previous webinars we've posted. Second, I'll be following up with you all via email tomorrow afternoon with the link to the recording as well as with the slides from today's presentations. Please be on the lookout for that. Finally, we welcome questions from the audience. Please send any questions you have to the Q&A function, and we will address them throughout the presentation or at the end of the presentation. Now with that, I'd like to hand this over to John.
Thanks, Justin, and thanks everyone for joining us today. Welcome to Technology Business Research Healthcare IT Services Benchmark Review. My name is John Caucis, Senior Analyst and Manager of the Public Sector and Health IT Services Research Practice here at TBR, and I'll be the presenter for our session today. I've been an analyst with TBR since 2001 and have directed our research program in both the public sector and health verticals since 2008. I just wanted to provide a little additional background information. Our focus within the healthcare IT services market is really to provide company-centric research to drive the success of our clients. The information that we'll be reviewing today comes primarily from TBR's Health IT Services Vendor Benchmark Report for the second calendar quarter of 2015, which hereafter I'll refer to as 2Q15, a report that published in late September. The report includes information on vendor strategies, strategic actions, key developments during the quarter, as well as information about vendor activities around alliances and acquisitions, and the overall fiscal and business line performance of the vendors that we track. The information that our Health IT Services team delivers is highly valuable to any vendor looking to expand their footprint or compete more effectively in the global healthcare IT services market. So with that, I'd like to begin our review of our most recent healthcare IT services benchmark study, and certainly as we go through this, I look forward to receiving your feedback and responding to your questions about the information that we will discuss today. So today I'll focus on three primary topic areas from our most recent healthcare IT services benchmark report and study. First, we'll cover some of the key financial highlights from the second quarter benchmark report, which published in September. Secondly, we'll discuss how the companies are responding to the market environment within their operations, their portfolios, their offerings, how they're leveraging partnerships and acquisitions to do so. And then finally, we will discuss the outlook for the healthcare IT services market for the remainder of 2015 and 2016, and then conclude with any questions that you may have. So I want to begin by reviewing some of the key financial metrics from the most recent benchmark study and how the conditions in the current healthcare IT services environment have impacted vendor fiscal performance. And in particular, we'll focus on trends in revenue growth and profitability and discuss the drivers behind the performance of the leading fiscal performers in terms of revenue and margin performance. And we'll also discuss vertical and geographic market trends affecting the companies that we track. In a nutshell, in 2014, we observed that the pace of EHR implementations really began to decelerate, especially towards the tail end of the year, as the large-scale EHR projects that had been launched several years earlier, going back to 2011, 2012, began to wind down. And the market, the EHR market, or I should say the first-time EHR buyers market, really became saturated towards the end of 2014. However, we've also observed since the end of 2014 and through the first half of 2015 that growth has been sustained primarily in the first half of this year due to the ICD-10 deadline that passed as of October 1st. We've also seen an increasing demand for so-called next-generation solutions, and these are solutions in and around population health management, revenue cycle management, analytics, mobility, mHealth and cloud, while interoperability certainly remains a critical element within the EHR landscape. So I want to take a moment to orient the audience to the graphic on this page. The blue line in the graphic represents the average total year-to-year growth for all of the companies that TBR tracks in the Healthcare IT Services Benchmark study. The red line is also a representation of average year-to-year growth, but it's calculated on a trailing 12-month basis for the benchmark companies in order to smooth out the impact of seasonality, seasonal events, as well as the impact of acquisitions. Both of the averages are weighted to account for the size of each benchmark company's respective revenue base in healthcare IT services. So in short, average weighted year-to-year vendor revenue growth did accelerate slightly as we moved from the end of 2014 through the first half of 2015. The large-scale strategic-level acquisitions by two of the vendors in our benchmark study in particular, being Cognizant and Cerner, continued to buoy average growth rates. This was also augmented by demand from payer and provider organizations that were really scrambling to prepare for the impending ICD-10 deadline at the beginning of October. We saw growth in these areas also helping to offset the lull in EHR work between the wind down in large-scale EHR projects and the eventual acceleration in EHR replacement projects, which we expect to see as we move into 2016. We saw that with the ICD-10 deadline approaching as we move through the middle of 2015, that many provider organizations were really compelled to defer new system sales and replacement and other types of IT investments in favor of preparing for the ICD-10 deadline. Though some of the vendors, such as an example, Allscripts noted that EHR replacements remained a key driver of their growth during the second calendar quarter of 2015. So we believe that the EHR replacement market will begin to heat up at the tail end of 2015 and certainly into 2016, in turn augmented by demand for solutions around quality reporting, clinical decision support, and security risk analysis, which stem from the upcoming Stage 3 meaningful use requirements. The rebound, the acceleration in average growth for the companies in our benchmark since late 2014 has also further widened the gap with the growth of the global IT services market, which we've plotted here with the green line at the bottom of the graphic. According to our most recent IT services benchmark study, also for the second calendar quarter of 2015, the global IT services market continued to contract on a trailing 12-month basis, and we expect the pace of the contraction to increase further as we move to the end of 2015, and we're attributing this primarily to traditional IT services, especially IT outsourcing, giving way to more as-a-service cloud models as clients increasingly demand services to be delivered in an as-a-service format. We project, and we've projected on the graphic here where we expect the market to go in the third calendar quarter of 2015, and later in the presentation we'll also talk about where we see things headed in 2016, but we projected growth in the global healthcare IT services market will essentially be sustained at its current level through 3Q15 and likely for the remainder of 2015 and into 2016. So with that, I'd like to shift gears and review how some of the contractors in our healthcare IT services benchmark study are performing relative to one another in terms of the size of their revenue base, their revenue growth performance, as well as their margin performance. So I'd like to take a moment to orient everyone to the graphic on this slide. Here we have an illustration of how all of the companies in the quarterly healthcare IT services benchmark study are positioned against one another in terms of top-line growth, in terms of margin performance as well as in terms of the respective size of their revenue base. And this graphic also calls out, in essence, which companies are growing the fastest and which are doing so most profitably. And we'll call out the drivers for the performance in just a moment. On the graphic, the x-axis represents the absolute dollar growth for each vendor's healthcare IT services business. The y-axis represents reported or estimated operating margin for each vendor's healthcare IT services business. And the size of the bubble, it represents the volume of revenue generated in the quarter through healthcare IT services sales. We did note that the average year-to-year growth rate plotted here at about 6% accelerated this quarter from about 5.4, 5.5% in the previous quarter. The trailing 12-month operating margin of 13.7% here, and both of these averages are plotted with the red dashed vertical and horizontal lines that you see here. The average trailing 12-month operating margin of 13.7 also increased from the first calendar quarter of the year, and we're attributing the increase in both of these metrics to the increased prevalence of more higher value solutions as we start to see vendors shifting more towards next generation solutions in many of the aforementioned areas: revenue cycle management, population health, analytics, et cetera. So even though the market slowed down at the tail end of 2014, we are starting to see these new solution areas become more prevalent in the portfolios and in the go-to-market approaches of the vendors that we track. So with that, I want to spend a few minutes talking about the growth leaders during the quarter. And in rank order, they were Cognizant, Cerner, HCL, and Deloitte. Certainly, Cognizant and Cerner, their growth performance continues to be buoyed by the strategic acquisitions that they made within the last year. And Cognizant also continues to add new healthcare client logos and is booking an increasing share of inorganic revenue after acquiring and integrating TriZetto. We also see Cognizant leveraging this expanded client base to successfully cross-sell more complementary BPO and consulting offerings, enhancing the solutions that it acquired from TriZetto, while they're also doing more work integrating TriZetto's platforms for its own base of payer clients. HCL, we attribute the revenue growth during the quarter primarily to the growth of its big data and analytics offerings, such as population health management. Their life sciences unit in particular continues to perform very, very well and is contributing about 2/3 of the revenue for HCL's life sciences and healthcare practice. And it's really the core of HCL's activities in the healthcare industry. Growth in the aforementioned business line, driven also by long-term engagements with many of its larger clients, such as Merck, as well as a number of infrastructure management awards that HCL landed later in 2014 that really began to ramp up through the first half of 2015. Deloitte continues to gain traction with its set of partner-run and proprietary portfolio offerings, such as in particular its Evergreen EHR solution. They've noted a number of awards in the U.S. public sector, as well as increasing demand for cost rationalization services for commercial clients, and the confluence of these factors helping to drive their revenue growth during the quarter. And we expect that this is going to continue for Deloitte through the second half of 2015. In terms of margin performance, the leading vendors in the quarter were, in order, CPSI, Infosys, and Epic. With respect to CPSI, they've been managing their payroll, their sales and marketing costs much more closely as of late, and this has flowed through to across their P&L, enabling them to drive improving margin performance over the last several quarters. Some of this was offset by higher general and selling costs, but they remain one of the margin leaders in our benchmark report. But we also see within CPSI the continued expansion of the higher value offerings within its portfolio, especially cloud-based managed IT services, consulting around revenue cycle and health information management, as well as clinical consulting offered through CPSI's TrueBridge subsidiary. Moving to Infosys, Infosys continues to leverage the low-cost service delivery approach to offer its clients more price-competitive healthcare solutions. It has also been focusing on improving operational efficiency at the corporate level. We believe that this has flowed down to its individual vertical practices. Infosys has been increasing the leverage of automation across its business, reducing on-site employees and reducing overall service delivery costs. Infosys also noted strong growth in the sales of analytics-enhanced platforms within its life sciences segment as being a driver of its margin performance, and helping to streamline the go-to-market approach from the new healthcare and life sciences unit, which it had recently formed, which has helped to further buoy the margin performance in Infosys' new, as I mentioned, the newly formed Highlight Health and Life Sciences practice area. Moving to Epic, Epic continues to leverage its tried and true, really strong project delivery methodology. This is underpinned by its pricing approach. Epic tends to take a more of a premium pricing approach to its EHR solutions, and this has helped to buoy its own margin performance. Also during the quarter, we noted that Epic, even though they have launched new facilities and expanded into, they've added new offices, we believe that the added cost of doing this was offset by its overall pricing approach. Epic's recent partnership with IBM Watson Health going forward, we expect will certainly enable it to incorporate Watson's cognitive computing capabilities into its EHR solutions, and in turn enhance clinical insight for its provider clients, which should enable Epic to continue to maintain its margin performance through the remainder of 2015. So from a vertical market perspective, called the SubVerticals within the healthcare segment, payer, provider, life sciences, and public sector, we observed several ongoing trends that I want to spend the next few minutes discussing. In the payer market, we saw demand staying solid throughout the first half of the year, mostly owing to the recent deadline for ICD-10 compliance. The vendors that we track noted that their payer clients also continue to invest in new solutions to modernize reimbursement systems to help them navigate the transition from fee-for-service to value, as well as better align with provider organizations and ensure clinically appropriate care. Within the provider segment, the vendors that we track noted that their provider clients continue to consolidate operations and facilities, in turn generating demand for IT solutions to integrate disparate systems and enhance their interoperability. Revenue cycle management offerings and solutions that enhance clinical processes were also noted as growth areas by several of the vendors that we track. In the life sciences segment, we've observed more large-scale life sciences organizations engaging in multi-service deals with the vendors that we track, leveraging, especially the larger vendors, leveraging their ability to provide more end-to-end cloud-based multi-platform offerings, as well as clinical R&D and increasingly IoT-related solutions. Several of the companies in our benchmark study also noted that they are seeing growth accelerate within their base of smaller biotech and pharma clients as well. Within the public sector, and this includes both the U.S. federal space as well as the U.S. State and local markets primarily, there continues to be a variety of factors impacting the vendors that we track. In the U.S. federal market, for example, healthcare spending is growing, although at a more marginal pace as budget uncertainty continues to persist in the U.S. federal market. We do expect growth to accelerate during the latter half of 2015, continuing to 2016, due to expected spending increases in Medicaid and Medicare-related programs such as the Children's Health Insurance Program. We also see new public wellness initiatives and the need for EHR upgrades increasingly factoring into higher healthcare-related outlays in the federal health IT market. Within the U.S. state and local healthcare IT space, we did note a slight deceleration in spending through the first half of the year as the Affordable Care Act, ACA-related surge in IT spending has continued to wane and moderate, but we believe that health IT outlays will begin to rebound in 2016 as budgets within a growing number of state governments continue to stabilize and outlays increase for the maintenance of ACA-related infrastructure and Medicaid-related systems. More state government budgets are moving into the black, and we expect that new outlays for social services and IT solutions to reduce waste, fraud, and abuse, as well as spending around the MMIS area will help to drive this as well. From a geographic market perspective, the U.S. certainly remains the core of the global healthcare IT services market, and where the pace of EHR replacements hasn't really taken off yet, but we do expect to see, as I mentioned earlier, an acceleration. Certainly in the U.S., the aforementioned ICD-10 compliance deadline was a factor this year, not just from a growth perspective, but also the impact that it had on clients in terms of pushing the pace and the decision to move in the EHR swap direction or to engage in other types of IT projects, kind of pushing those things to the back burner as they focused instead on updating their IT and billing systems to accommodate the shift from ICD-9 codes to ICD-10 codes. Also within the U.S., as well as in other geographies, we've noted the continued increase in the proliferation of mHealth, in turn generating the need for more robust security solutions, an area that we expect to see growth accelerate in 2016 as well. Within the Americas region, Latin America is also increasingly becoming a solid market opportunity for the vendors in our healthcare IT services research program. Growth in Latin America remains driven by strong demand for EHR systems, especially in Mexico, which is a market that many of the vendors that we track view as a staging point, if you will, for further expansion into the Latin American market, as well as viewing Mexico as a kind of a proving ground for their healthcare IT services solutions. It's certainly one of the more mature markets in the Latin American region. In the larger Latin American region, we're also seeing telemedicine increasingly being seen as an enabler of enabling the connection, if you will, of rural areas to healthcare providers. But the market still remains highly fragmented. The Latin American market, there's many different regional healthcare IT markets. The vendors in our benchmark have noted, this characteristic of the market has made it difficult for them to go to market in the Latin American region using a single standard go-to-market strategy. Instead, this has compelled them to take more of a country-specific approach in Latin America. Shifting to EMEA, We did observe a modest acceleration in healthcare IT services spend in the EMEA market as government-sponsored initiatives to modernize healthcare IT systems increase and healthcare organizations seek to upgrade to and integrate mHealth and digital and analytics capabilities. EMEA-based payer organizations are also increasingly demanding solutions to help them reduce costs and expedite the processing of patient claims. Shifting briefly to APAC, we see healthcare IT services spending remaining robust in the APAC region, though a handful of the vendors that we track noted that negative impacts from slowing public sector spend in Australia and New Zealand. And in addition, while the overall market, and vendors in the market are capitalizing on the rapidly expanding regional spend on healthcare IT services solutions, end users tend to be more price sensitive, especially in the less mature markets in APAC, and they appear to be somewhat off-put by the higher initial costs of implementing health IT solutions, at least those being offered by non-Indigenous, or I should say non-APAC-based vendors. They've kind of expressed a preference for doing business locally with local providers. We do believe that healthcare IT services spending in APAC is poised for acceleration in 2016, driven by increases in medical tourism, increased government spend on EHR investments, and the modernization of other aspects of healthcare IT services systems, in part to resolve more widespread interoperability issues, but also to implement telemedicine solutions on behalf of provider organizations in the region. So with that, I'd like to shift gears and spend the next few minutes talking about vendor activities that we observed during the second calendar quarter of 2015 to align with the conditions and demand trends in the market environment. And in particular, we'll summarize key developments regarding new alliance formation, acquisitions that were made during the quarter, as well as new solution introductions. So I'll begin with a few minutes discussing the acquisitions made by a handful of vendors, key acquisitions made by a handful of vendors during the quarter. And we saw the focus, kind of the common thread across certainly the vendors that we've profiled here, as being desire to enhance capabilities primarily in consulting as well as analytics and cloud. I'll call out the examples here. Accenture announced that it was buying U.S.-based strategy consulting provider Axia in the beginning of the second calendar quarter. I believe it was back in April, with the stated goal of enhancing its performance management consulting capabilities. IBM also bolstered its Watson Health Cloud platform with the acquisition of Explorus and its own secure cloud computing platform, which is used by, I believe, 26 major integrated healthcare systems to identify patterns in diseases, treatments, and outcomes. We estimate that Explorus will add about 140 to 150 employees within, bringing with them healthcare intelligence cloud experience, as well as adding between $20 and $30 million in inorganic revenue to IBM's healthcare IT services revenue base through the second quarter of 2016. IBM also purchased a Texas-based population health management software company, Fitel, to bolster its Watson Health Cloud platform in the areas of patient care, improved patient care, and cloud-based delivery services. Xerox was also active on the acquisition front during the quarter, acquiring California-based HCI. From that acquisition, Xerox was able to gain a SaaS platform that supports the management of population health with provider organizations, and the platform we see will be integrated into Xerox's Midas JuvoCare platform, I should say Midas JuvoCare Performance Analytics platform. Shifting to alliance activity during the quarter, we've called out the alliances formed by a handful of companies during the quarter, IBM, the Dell Services Group, and Accenture. Once again, with IBM, the launch of the Watson Health Unit in April coincided with the aforementioned acquisition announcements, as well as the announcement that it had expanded its alliance with Apple, through which all healthcare data collected from Apple devices will be stored on the IBM Health Cloud for Watson solution. We believe this partnership will offer healthcare providers, payer organizations, and patients greater insight into medical research, and IBM, we expect, will leverage the data obtained through Apple's Health Kit and Research Kit to develop more enterprise-level applications under the IBM Mobile First for iOS. We also see these applications enhancing enterprise clients' ability to manage their employees, their own employees' healthcare needs and practices. In May, Dell joined the ThingWorx System Integrator program as a global system integrator, and we see this as enabling Dell to integrate ThingWorx IoT solutions, and it'll really serve as enable Dell to serve as a consultant and a service provider to clients implementing this IoT platform. The real-time data analytics capabilities will also enhance Dell's own IoT and machine-to-machine capabilities in enabling patients and their providers to track and to measure healthcare data in real time. Dell also allied with TechSpring, a Massachusetts-based healthcare innovation center, to launch a new program leveraging predictive analytics in telehealth, electronic visits, and telemonitoring in particular, to provide more actionable data to clients with chronic illnesses. We see Dell as reviewing the socioeconomic data and the clinical information that it collects to complete an assessment of the identified at-risk populations that will be impacted by this solution, and this alliance, I should say. And we also see TechSpring then using this information to, in turn, develop and implement more clinical models and procedures that will effectively treat high-risk patients while also reducing costs and improving communication with providers. Then finally, Accenture and Metadata Solutions partnered during the quarter, which enhance Accenture's Life Sciences Cloud for R&D solutions. We see Accenture as leveraging the cloud-based metadata RAVE solution to manage data and analytics reporting, as well as integrate metadata clinical cloud, its clinical cloud solution to improve automation in R&D, as well as enhance and accelerate time to market for products in the life sciences space. In terms of new solution announcements during the quarter, the key theme was really solutions in the next generation areas, such as cloud automated care, population health management, and digital patient engagement. We've noted a handful of vendors here, such as McKesson, who introduced a number of new digital solutions during the quarter to enhance patient engagement and workflow efficiency for healthcare providers. McKesson did a number of things. First, they updated their Relay Health Enterprise Patient Portal to provide patients with access to their health records. This will also enable patients to engage with a number of care providers through a single point of access. McKesson's One Content solution, as part of the series of new solutions they introduced, will enable enterprise users to manage and archive documents from a number of different areas of their businesses into a single document management marketplace. McKesson also updated its InterQual solution during the quarter to expand the breadth of its evidence-based content, which will enable its provider clients to make real-time decisions across the spectrum of care. With respect to Accenture expanded and enhanced its Life Sciences Cloud for R&D, as I mentioned a moment ago. This solution, I'll also note, is hosted on Oracle's data centers, and the expansion will include the Oracle Health Sciences Data Management Workbench, Accenture's clinical data management platform we expect will help to automate, process, and enhance data collection, analysis, and workflow for its life sciences clients. NextGen also announced the release of its population health management and care management solution known as NextGen Care. This solution combines automated patient engagement and ambulatory solutions into a single, more comprehensive system, which in turn enables its provider clients to better manage multiple engagements involving numerous patients on a single screen. We also see NextGen Care as giving provider organizations real-time, actionable risk scoring insights to identify gaps in patient care, as well as expedite patient outreach through automation. And then finally, Xerox. Xerox plans to offer its robotic process automation technology to boost productivity and improve efficiency for healthcare payers, such as New Jersey-based payer Horizon Health Services, which uses the automation Xerox's automation tools to enhance the accuracy of its internal claims transaction processes. So our final topic area for today will be on the growth outlook for the next 6 to 12 to 18 months for the firms in our healthcare IT services benchmark study. And in short, we expect the momentum within the global healthcare IT services market that began to accelerate in the beginning of 2015 to continue to be sustained in and around the level that we've seen through the second half of the year and into 2016. Let me take a quick moment to orient everyone to the graphic here. What we've done here with the blue line on the graphic is represent the average total year-to-year growth for all of the companies in our healthcare IT services benchmark study. We've weighted this to account, once again, for the size of each benchmark company's respective revenue base in healthcare IT services. We've gone back a bit to capture the data beginning from the year-ago quarter, as well as provide projections for the upcoming third calendar quarter of 2015, a report that we expect we'll be publishing in about a month or so. We've also provided our view on where we see the market headed in the fourth calendar quarter of 2015, as well as our projections for 2016. So what we've observed is, after bottoming out in the latter half of 2014, we expect that average growth will be sustained in and around the level that we've seen it accelerate through the first half of the year. And despite the pace of new large-scale EHR implementations continuing to decelerate, we anticipate that healthcare organizations will slowly shift their IT services investments to newer solutions in many of the aforementioned areas: revenue cycle management, population health, analytics, for example. The recent acquisitions, the strategic level acquisitions by Cerner of Siemens Health Services and Cognizant of TriZetto will continue to provide an inorganic boost to average growth rates, but only through the third calendar quarter of this year. The methodology that we use to account for acquisitions is to consider the acquisition fully integrated from a revenue standpoint at the one-year anniversary date. So the impact of those acquisitions will begin to wane, but despite that, we expect growth rates to be sustained at the levels that we've illustrated here. We also see healthcare IT service providers enjoying solid growth and cash flows, along with strong margin performance, as they continue to be flush with cash, and they continue to seek acquisitions, leveraging that cash to make acquisitions to accelerate growth and expand into adjacent or emerging healthcare IT services areas, many of which we've already mentioned: mobility, revenue cycle management. We've also seen an increase in investments around consulting We talked about Accenture earlier. We've noted interest in consulting around operational improvement and performance management as well. And then we also see security increasingly becoming a strategic priority for healthcare provider and payer organizations, and in turn, we see this flowing through to the vendors that we track. Certainly the certainly the increase in frequency and sophistication of cyber attacks is driving this and prompting healthcare organizations to accelerate their own efforts and investments to secure their data and patient data. So that concludes the presentation, and we're happy to, at this time, take your questions.
All right, and excuse me. Just a reminder, you guys can please send your questions to the Q&A function, not the chat function. It's just a lot easier for us to sort through on our end here. So let's go through with what we've got in so far. All right, first question. The federal dim sum award was finally made in July. What do you think the impact will be?
Okay, thanks for the question. Dim sum, after several years of machinations, was finally awarded at the end of July, and we see that the primary impact of dim sum most likely being on the continued drive toward interoperability across the healthcare IT services market, and healthcare IT market in general. In fact, we expect dim sum will reverberate throughout the global health IT market for many years and help accelerate the cause of interoperability. Of course, if the project is successful, and we certainly don't mean to diminish the original and the principal goals set forth for dim sum at its outset, which were to leverage the continued introduction of, or the continued, I should say, innovations in the commercial health IT market. But we also see that there's going to be at least an equally substantial impact on interoperability initiatives, certainly in the U.S. and in the federal market, but in fact across the globe and across commercial markets as well. We also fully expect dim sum's benefits will flow through to the private sector and act as almost a strategic directive to the HR market to accelerate interoperability initiatives, certainly in no small measure due to the massive size of dim sum. 9.5 million beneficiaries in the DoD, I believe, will be impacted, and even more in the VA side, while more than, I believe, half of the care provided to these beneficiaries will come from the private sector. So all of this underscores the impact that dim sum is going to have in the commercial health IT market, and we believe that dim sum will really finally generate the gravity, if you will, that will be needed to pull the private sector towards better and towards more pervasive data sharing, and by raising the bar in interoperability.
All right. Next question. Can you clarify the growth components of M&A versus actual market growth? So the M&A could have accounted for much of the 7% since none of those acquired firms are part of the baseline.
Thanks for the question. We estimate, and we can certainly follow up on this, but we estimate that of the growth rates that we profiled earlier, the inorganic component would be between 2 and 3%. But we'll take that as a follow-up because we do have that data modeled out.
All right. Next question. The ICD-10 deadline has come and passed. How do you see that affecting the market?
Okay, thanks for that question. Certainly, ICD-10 really took center stage during 2015 as the customers of the vendors that we tracked were really scrambling to prepare for the deadline. Many of the vendors that we follow reported an uptick in demand for services around assessing ICD-10 readiness, but the flip side of this, as I mentioned earlier, was that many of these same organizations had to kind of push new system search and replacement to the back burner, as well as other IT projects and investments related to health IT. So what this did is it had the effect of driving a bit of short-term softness in the market during 2015 that we expect. Actually, we've seen evidence that this has already passed as we move to the end of the year and move into 2016, and we see more pent-up demand reigniting, being reignited for solutions around EHR replacement, RCM, revenue cycle management, predictive analytics, and population health management. In fact, we've discerned a fair amount of lead traffic, if you will, around these areas, and we see the market will be increasingly looking for vendors that can not only address this and not only provide really rich analytics capabilities around RCM and the population health, but can also at the same time address the issue of interoperability.
All right. Let's see. A couple more questions came in here. Any ideas, impacts from political instability in the U.S. during the election year, either accelerating to beat schedule or deferring or terminating?
Well, thanks for the question. I think the best way to answer that is to kind of look upmarket at the overall federal space and what we've observed there and what we've heard there. Certainly, that market has moved into more of a stable period, although many of the vendors that we track in the public sector markets, as well as vendors that we track from a healthcare perspective in the federal market, have noted that the upcoming election, the upcoming national election is going to be a factor. It's introduced another element of uncertainty into the strategic planning for the next year. We don't have any evidence at this point that it's a bit early, a year out, that it's having an impact on the upcoming election is having an impact on the commercial markets. So once again, something that we can take as a follow-up, and something that we will be tracking closely as we go through 2016.
All right. Another question. How do you expect the mega mergers in payer to play from a share shift point of view? Who are the winners and losers in your view?
I'm not seeing the question on the chat function here. Is this something that...
It's on the...
I can see it. Okay. Do you want to read it again?
Yeah, could you read it again for me, please?
How do you expect the mega mergers in payer to play from a share shift point of view? Who are the winners and losers in your view?
Are you referring to the consolidation that we've seen with large-scale provider organizations? I'm unclear as to the question.
Yeah. So, well, I guess another way to lead the question is, who's going to win and lose in payers? I mean, just going forward, setting aside what mergers it takes, the mergers in like United Healthcare and who else merged recently? There were a couple of big mergers of the payers, the insurance companies, and so from the point of view of the healthcare IT services vendors, who's going to benefit from, top 5 becoming the top 3? So who's going to benefit from that? I mean, my guess would be that everybody. The short answer is everybody, because any kind of merger like that creates all sorts of legacy systems that you have to integrate and uplift and all that kind of, I don't want to say crap, but I just did. But what's the long answer, John? Who are the guys that are best positioned in the payer space?
By the way, that was Patrick Heffernan, the director of our cloud professional services practice. Well, I think the companies that have the strongest legacy in the insurance sector, certainly, and we certainly the MNC players like an IBM and Accenture, CSC, strongly positioned there. Many of the India-based outsourcing vendors like an Infosys have also cut their teeth in the insurance sector, and we see them as being well positioned to address that as well. But certainly, with that consolidation is going to come the need for scale, and that plays to the strength, I believe, of the MNC players.
Yeah, if you just look, we have the slide up here that's got the different big players that are tracked in this benchmark, and You know, as much as I think we admire or as much attention as we pay to folks like HCL who have a lot going on in their life sciences practice and who are clearly on the right side of that particular chart, growing in the right direction, John, you're right. Scale, when it comes to that kind of mega merger, when it comes to handling clients of that size, it really is. It's IBM, Cerner, Accenture, who else? I mean, I guess HP too. I mean, really, and Dell. You're talking about the biggest ones, and really that's it, I think.
And yeah, you probably want to throw Cognizant into that group because they acquired some substantial payer software capabilities with TriZetto. So they're well positioned there. I'm not sure if I put Cerner into that group. I'd have to go back and check to see what our estimates for their their exposure to the payer market. I tend to think of them as more of a player in the provider market because of their EHR legacy. But yeah, absolutely, you can't discount the value of scale.
That's what the other thing is. This question points out is that in a lot of for a lot of this, it's a benchmark. So we're sort of forcing a lot of the different companies into our buckets of how we understand them when we're trying to make the apples-to-apples comparison. For many of these vendors, we also do a separate semi-annual healthcare IT services report that just looks at them in much more detail. And so, obviously for a webinar like this, we can't go into every detail on every company, although John certainly got real exhaustive in real detail during his presentation. But I think that's one aspect we can follow up on with folks asking questions. And again, John's contact information is all there. You can reach out to him. John, the next question is, what is the biggest hindrance to healthcare IoT growth in the payer market? The payer side.
It's a good question. Not being as familiar with IoT, but I'll take a shot at this. I think security, because we've seen security being an issue for around the mHealth area. We've seen a lot more discussion around security, and security remains well, actually, let me rephrase. Security has really has been elevated to a board-level concern in many of the verticals that we track here at TBR, and it's certainly including healthcare. So if I had to pick one area, I would say security.
Yeah, and so this is the third webinar I've been on this week. We covered business intelligence and analytics, we covered global delivery, and now healthcare IT services. And what has come out in every single webinar is this idea of security services, cybersecurity services. Really, in this coming year, I think we're going to see a resurgence. It's not that security hasn't been something that is always, whenever we do customer surveys, whenever we talk to folks, security is always at the top of the list. I think security for the last 18 months or so has been in the news and on people's minds, but not something that they've been spending extra money on. I think we're going to see a shift this year, and IoT is part of that shift. As more enterprises, as more companies look to understand what they can do with IoT, it's going to reveal the amount, the risks that they have around security. And so I think we're going to see that element become, and it's so baked in already to many IT services engagements that the challenge is on us here at TBR to actually strip out what the IT security services element of the engagement is and understand its growth. But I think that will be something we're talking about. For all of 2016, I think we're going to be talking about the impact of cybersecurity on services across the board.
All right. Looks like there's only one last question in the queue, and that is, what do you see happening with mergers and acquisitions in health IT?
I think another question came in, but I'll answer the question about M&A. It was a question about infrastructure spend related to, I'm assuming that's platform as a service, but let me address the M&A question first. Thank you for the question. We expect that the pace of small-scale acquisitions of niche capabilities is going to remain fairly healthy across the vendor base that we're following. The aforementioned areas: revenue cycle management, analytics, population health management. But we also, and we noted this with Accenture a few minutes ago, we're also seeing an increasing interest in acquiring consulting capabilities. Accenture acquired Axia. They also recently acquired, I believe it's pronounced Sagacious Consultants. And we think these are good examples to illustrate this increasing interest in being able to consult to healthcare organizations at a board and C-suite level. And these, from Accenture's standpoint, we see these acquisitions as being consistent with their ongoing effort to enhance their own strategy consulting capabilities and management consulting capabilities to match the capabilities of rivals such as the Big Four rivals, as well as the strategy shops, if you will, McKinsey, BCG, Bain, but also add specialized consulting capabilities in an area that they've identified as a strategic growth market for themselves.
All right.
And there was a question about our estimate for the proportion of HIT spend around platform as a service. We don't have that data. It's not an area of focus currently within the HITS research program. Actually, do we have anything at the global IT services level that would help? Because I would expect that whatever the level is at the global IT services level, it's probably going to be,
it'll mirror.
Yeah, but
we'll get back to the person who asked. I think it's the best way to handle it. We don't have it off the top of our heads, and I don't want to speculate too much, especially as we're hitting the top of the hour.
But I would expect that whatever the number is at the global level, it's probably going to be a somewhat lesser proportion in the healthcare space for a couple of reasons. We talked already about how ICD-10 has kind of pushed other investments to the back burner. There's less, even in the U.S. market, there seems to be a less mature IT organizations. Certainly the EHR gold rush, if you will, over the last few years, has kept the focus on the EHR. But now what we're seeing is that especially providers are kind of moving up from EHRs. They've got these systems in place. What are they going to do with them? What are they going to do with all of the tremendous volume of data that's being generated by these systems? So now the focus is moving to these newer areas. So I would expect that the proportion in comparison to the global IT services market of platform as a service type solutions and spend is probably lower.
All right. Well, those are all our questions and all we have time for today. So I'd like to thank John for your time today with the presentation, and thank you everyone for your attendance and for sending in your questions. You can follow John as well as TBR on Twitter at the handle listed here. Please check out our pages on SlideShare and YouTube as well for our previously aired webinars. And before you sign off, I'd like to ask you to take a brief survey on your attendance today. We're always looking to improve the information we provide and how we provide it to you. So your feedback would be greatly appreciated. We'll leave the chat function open for another minute or so for people to send in any last-minute questions or comments. Otherwise, thanks for attending, and have a great afternoon.